My name is Trevor Nelson. I'm a chartered accountant, certified financial planner. I've been in the insurance estate planning industry since 1991. The specific tax savings to naming a charity as a beneficiary of a life insurance policy can be somewhat complicated in the sense that there are specific rules that Revenue Canada requires to be followed. In the sense of naming a charity a beneficiary, you do need to name them as an irrevocable beneficiary. In doing so, if you continue to pay the life insurance premiums as an individual, you will then receive a charitable contribution receipt for those premiums that you have paid. The particular type of insurance policy that you have will also depend upon the amount of premium that's required. Should you discontinue funding the premiums, then also your charitable contribution receipt would then discontinue at that point. The charity at that point could then decide, if they wish, they could obtain ownership of that policy and continue to fund it themselves or through other donors. As you pay the premiums and the charitable organization issues you a taxable receipt for that contribution, that receipt can be used to offset your income tax. The rate at which you will be able to receive it depends upon the charity and which rate that they're able to issue that receipt at. For that kind of advice, I would suggest that everybody talk to their independent tax advisor, as each person's situation is different from a tax perspective. Very simply put, a life insurance policy, there's a couple ways of donating the benefit of that policy to a charity. One is, if you own a policy already, you're able to name the charity as a beneficiary, as we have discussed, and you can continue to fund the premiums on that. What is becoming much more popular, or what we've seen, is where you actually donate the policy to the charity. The charity then would receive not just the death benefit, but they would actually obtain the ownership of the policy today. At that point, when doing that, you would need to have a fair market value calculation done on the policy. For an example, if you had a policy with a face value of $500,000 and you were 75 years old today and your health was failing, the fair market value of that policy, as determined by an actuary, could be in the neighborhood of $300,000 to $400,000. Once the actuary has completed his work, the charitable organization would be able to issue you a receipt for that $300,000 or $400,000. So while the charity will not receive the face value of the $500,000 for some point, you as a donor would have that tax receipt in your pocket today, and you could use it according to your income that you have as a deduction. There are a considerable amount of life insurance policies out there that people have that they don't understand the real true value that still exists in these policies. Lots of people decide that at some point in their estate planning or as they advance in their age that they don't want this insurance or need it anymore. What they really miss is the value, the potential tax savings that they can generate by looking at donating this policy to a charity, as I had discussed, that a fair market value would be determined. If they're not able to continue to fund the policies, there are groups out there that will go and seek donors to continue to pay those premiums. So it's incumbent on people to take a look at this before they just phone their insurance agent and cancel the policy. And I think it's incumbent upon insurance advisors out there to work with organizations such as Community Foundation, that when these situations do arise, that they make the policy owners aware of the extreme potential that does exist, not only from a tax saving point of view, but from a great charitable gifting opportunity.